Good morning and welcome to this Tuesday, September 19th, 2023 edition of Trading Places Live with earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we take a look at what's going on in the market and, of course, prep for the latest Fed meeting, which starts today. We will get the policy statement out tomorrow at 2 p.m. Eastern. I think most market participants are expecting a pause, but what will the Fed say? That could be a different story. And we do get surprises every once in a while from the Fed. I think they'll probably simply remain vigilant, talk about the fact that they may continue to raise rates. They're going to continue to watch data. That's what I'm expecting to hear from them tomorrow. But maybe they go kind of crazy. Who knows? I don't know. I don't trust this current Fed too much, as you probably know by now. And so we'll see what they come up with, and we'll go from there. Market continues to consolidate. No big surprise there. We are in the summer months when the market tends to be a little slow, but we're getting closer and closer to the fourth quarter. And the fourth quarter is the best period historically, dating back to 1950 on the S&P 500. So we got the bullish fourth quarter ahead, but we got this little bridge we got to kind of get over before then. And quite honestly, the next week or two, I could flip a coin. I'm not sure which way the market's going to go. We do see some areas of the market that seem to be a little underwater technically, other areas holding it up. And so we just continue this sideways consolidation pattern, which is frustrating, no doubt about it. I mean, it's certainly hard to trade whether you're on the short side or the long side because it just doesn't seem to want to go in either direction. But I think patience is a virtue in the stock market, and we do need to remember to be patient during these periods because things will be brighter. At least the way I'm looking at it, I think things are going to be brighter probably sooner rather than later. Looking at the futures this morning, hold on one sec. We've got Dow futures down 35, S&P 500 futures down about 4, NASDAQ futures down 23, crude oil prices higher. Crude oil prices over $93 a barrel now. Crude oil is up $1.50, actually $1.48. It's 92.96, came back down just a little bit, but still up 1.6% today. And we've got the U.S. 10-year Treasury Yield, 4.357%. Up 4 basis points this morning. So here we are once again with this 10-year Treasury Yield right around this 433 to 435 level, actually just slightly above it as we await the Fed. I am not quite sure, of course, when the yield's going up, that means folks are selling bonds. When bond prices go down, yields go up. So I think what we've been seeing is maybe a little bit of just selling of bonds ahead of a big event. Folks just don't know which way we're going to go and probably just want to get out. We see it, that resulting in the yield popping just a little bit to the upside. Do I think it matters if we go to a 10-year yield of 450, 475? Personally, I think the market will withstand it. Look at where we are right now with the 10-year Treasury Yield, 4.36%. Where were we in October of last year? 4.33%. So we're up 3 basis points from where we were in October, and everybody was fretting about higher interest rates. And yet interest rates are slightly higher than they were last October. What's stock market done? Stock market came off that bottom in October of 34.91, and yesterday closed at 44.53, up 1,000 points. So clearly the stock market is adjusting to a higher interest rate environment. Would 450 make a difference? 475? Personally, I don't think so. I think there will be an initial shock, but I don't think that would necessarily take this market down. We start putting a 5 handle on it, and that's when I start getting a little bit more nervous because you have alternatives. You have a lot of folks that are investing in the stock market that would probably take a nice 5.5% yield from the government and say, that's it, I'm good. And you start seeing money rotating out of the stock market because of interest rates getting too high. That's a problem. That's when you start to see major rotation away from U.S. equities. I don't believe we're there yet, but I do think that this is the potential catalyst if the Fed were to say something and the 10-year Treasury yield take off to the upside, that could spur the selling that we typically see in late September. So keep it in mind. You might be saying, well, which way do you think it's going to go? Honestly, I don't know. Next 2 weeks, I don't know. I'm really bullish about the market into the fourth quarter and into year end and into 2024. But these next 10 days, I don't know which way we're going to go. I wish I did. I'd be set up for it. I just think you continue to be cautious, whatever that means to you. If you want to short, feel free. I'm not a fan, but completely up to you. We might get that one more pop to the downside in the market. We'll see in the stock market. We'll see. Anyhow, let's go ahead and take a look at what happened yesterday in the market. So give me a second here. Okay, so on Monday, we saw the Dow Jones Industrial Average finish up a whopping 6 points. For those keeping track, that's 0.02%. S&P 500 up 3 points. That's 0.07%. NASDAQ up 23 points. That's 0.15%. Mid caps dropped 3 points, which is 0.12%. And small caps continue to underperform here in the near term, dropping 1.2 points, but that was about 2/3 of 1%. So clearly, small caps took it on the chin yesterday. Transport's also not a great day, dropping a little bit more than 0.5 of 1% as it continues to try to sideways consolidate and hold on to some support just above the 15,000 level. Moving on to the sectors, energy up 0.85%. So not too far from full percentage point. Energy up over $92, or at least the ETF. And with the crude oil prices now up $1.76, by the way, 93.24. So it's up almost 2 full percentage points, crude oil. That is likely to add more fuel, no pun intended, to the energy group. So I would look for another breakout there, to be honest, the way crude oil prices are trading. Technology yesterday was up 0.8 of 1%. But on the other side of the spectrum, the worst performing sector was discretionary, which was down more than 1%. So we have technology, one of the three aggressive groups among the leaders yesterday, and then we had discretionary down on the bottom. Discretionary has been pretty strong of late, but the last 2 or 3 days, we have seen it turn back down, and we finished on the XLY yesterday at 169.62. The 50-day, 169.91. The 20-day, 169.78. So you got both those moving averages coming together, and the XLY finished just beneath both of them. Now, again, I think we're in a trendless, well, I don't think. Looking at the charts, I think it's pretty clear. We're in a trendless environment right now. Since the top in July and the bottom in mid-August, we've kind of been just chopping back and forth within this range. So the XLY moving back down below these two moving averages is not that big a deal. Whenever you're in a trendless market, moves up above and back down beneath moving averages are normal. It's not like when we're trending. When we're trending up, I really pay close attention to those 20-day moving averages just for signs of maybe a more significant pause. When you're in a trendless environment, you just kind of go up above and below those moving averages. The moving averages to me almost become meaningless. It's really which way do we break out of this sideways consolidation? Do we break to the upside, taking out the July high? Do we break down below the August low? Those are going to be the key questions on most charts that we look at right now. From an industry group perspective, computer hardware up 1.5, almost 1.6% yesterday. And it is, it got close last week to its August low, but now it's turning back around, moving back up close to that 20-day. But again, I'm not sure the moving averages really are going to be that impactful at this point. Specialized consumer services up 1.4%. This is a group that actually did go below the August low, as you can see, rebounded yesterday back up above it. We'll see if we can get back through the moving averages, maybe start to bounce off of them. But until then, sideways consolidation. How about the autos? Autos in a nice little uptrend. This is one of the stronger areas off the August low. You can see that this is a group that has been trending above the 20-day moving average. Coming back down yesterday, lost 3%, still just above the moving averages. Do those moving averages hold? If so, maybe we have an uptrend in the autos. If they don't, more of the same. Chop, chop, chop. All right, 10-year Treasury yield. Let's get an update here again. Fed meeting just started this morning. Right now, 4.36%, with that yield up 4 basis points. Closed yesterday down around 4.32. So do we make this breakout to the upside? Again, my feelings are it is not going to be a good look for the stock market if the Treasury yields break out. I think it would lead to short-term selling. One thing that we need to keep an eye on is the 5-day moving average of the equity-only put-call ratio. That is a very, very strong signal in the short term for stocks. And the 5-day moving average is still showing very high pessimistic readings, which typically coincide with market bottoms. Now, we've been hitting this 0.85 area on a 5-day moving average of the equity-only put-call ratio. That, normally 0.80, when you get above 0.80, that normally you can start looking for major bottoms. Doesn't mean we can't go to 0.9. And I think if interest rates go up and market sells off, I think you'll see a lot of folks turning very bearish in the near term. And I could easily see that moving back up to 0.90, the 5-day moving average. So 0.85 or 0.80 is kind of a threshold where historically we've run into some key bottoms in the market, but 0.80, 0.85 doesn't necessarily have to mark the bottom. We could go to 0.9. It's just telling us that the market's very fearful. And if we do go down, I think it could be swift, but I also think it could be a big drop, but it also could be very swift in terms of time, duration. Don't think it would last long. All right. So what else? How about the major indices? S&P 500 finished yesterday. Allergy time of the year. I apologize. Fall starts to get to me. Anyway, S&P 500, 4453. So it's close to the low we saw back at the beginning of September, but still over 100 points away from the 4335 low that we saw in August. Hey, if the Fed says something, or if the market, for whatever reason, goes into a tailspin here, S&P 500 could go back down and retest that 4335 level. Would not shock me. Wouldn't even shock me if we put in a slightly lower low to go back and retest the breakout from 4305 that was the high back in August of 2022. So those two support levels, I think, are still in play until we get past this period and move into October. So again, these next 2 weeks, next 10 days, going to be really critical here in the short term. NASDAQ 100, same thing, sideways consolidation again, right near this low that we saw back earlier in September. NASDAQ stocks struggling a little bit on a relative basis to the S&P 500. Of course, the small cap Russell 2000 struggling relative to both right now. You can see the IWM. And by the way, yesterday was the 9th day out of the last 10, I believe. Let me check this other one, whether it was a higher close above open. Actually, that is a slightly, that was a close above the open. So we had 5 filled candles in a row, meaning that you close below the open 5 days in a row. It's definitely distribution. Now, it's still within a pattern where you still got your support, but 5 days in a row with filled candles, never a good thing. Then 2 of the next 3 days, we saw slight reversal there in that we were closing back above the open. But then the last 2 days, right back down, finishing near the lows again. Yesterday, we were right on the low at the close. So do we hold on to the August low with the IWM? I don't know. I don't think that that's the most important low on this chart, but it is a low that I think there are going to be traders that are going to trade off of it. If you see a breakdown, you're going to see some more selling, I think, in the IWM. I think probably 179 to about 181. That's the highs that we saw back here in the springtime, this was a period when in my opinion, the IWM was starting to show some strength, even though you didn't see it on the chart. The small cap growth stocks begin to outperform small cap value during this period. So I thought that was a positive. We later followed it up with a breakout, but that breakout occurred at 179. Notice this candle goes back to 179, then we break out through about 181, go back down, we hold right around the 180. So I think this 179, 180, 181 area is the biggest level on the chart. I think if you lose that, I mean, that brings into maybe even the upper 160s to around 170. And remember, if this stock market gets going to the downside, it could be a fairly significant drop. You got folks that are really nervous, at least in terms of playing options. We get interest rates breaking out. The Fed says something. We lose a couple key support levels. Yeah, I could see things picking up rather rapidly to the downside. So I think that's a possibility. I don't think that's the highest possibility, but I do think it's a possibility. So let's watch this 179 to more recently 182. That area of support is going to be critical, I think, for the IWM. Transports moving lower, have been since the end of July. Nothing really signals to me on this chart that we're done to the downside. I don't know, maybe an hourly chart. Let's see what the hourly looks like. Well, down here at the bottom, we did actually have a positive divergence. So we had the higher PPO with lower prices, but we've resolved that. We've gone back up now. This is what I call a PPO reset. We've gone back down to the 50 period moving average, which in this case is the 50 hour. And notice the PPO, hourly PPO, has gone back to the zero line. Once you go back to the zero line, any momentum issues are over and done with. I mean, if you have a divergence, the divergence is resolved with a zero line test. Why? Because both moving averages, your shorter term and your longer term, are the same. There's no momentum. So any momentum issue, any divergence, momentum divergence has been wiped out when you get back to zero. So I think transports on the hourly chart are free to go whichever way they want here. But the daily chart would suggest down versus up. What about the longer term weekly chart? What does that look like on the transports? Well, we're sitting almost right on the 20-day still. I mean, this is an area where we could launch to the upside. So that's what makes it confusing here, is that most of the longer charts I look at right now, which to me trump the shorter term charts, but most of the longer term charts look good. So that's why I'm believing that any kind of weakness in the market's going to be short-lived. All right, let's move on. Chart of the day. For those of you who are interested, you can go over to earningsbeats.com. That's where I'm from. That's where I belong. I'm chief market strategist there. Go to earningsbeats.com. That's our home. Scroll down. There's a free newsletter that you can sign up for. Name and email address, all it takes. No credit card required. You can unsubscribe at any time. 3 times a week newsletter, just talking about the things that we think are important. Throw in trade candidates from time to time. I talk about why I like a trade. And then, of course, it's up to you. You're completely responsible. I always say and try to remind everyone, I'm not a registered investment advisor. No one at Earnings Beats is a registered investment advisor, and Earnings Beats itself is not an investment advisor, registered investment advisor. So we are not licensed to give out advice. So I don't even like the word advice or recommendation. Everything we do is really, it revolves around education, things I've learned over the years. I continue to research the market. I try to pass that stuff along. And then what everyone does with it's completely up to them. I'd like to think that the information that we provide at Earnings Beats helps everyone manage their investments better, makes you think about some things from time to time, maybe be a little bit more cautious when signs point to being more cautious. But as far as, you know, trying to manage a portfolio, we don't do that. And we can't do that. You know, we reach out to so many people through our shows, through our, you know, my blog over at Stock Charts. We've got members from around the world. We got folks that are extremely wealthy. We got, you know, wealth managers that rely on our service. And we also have folks that are just getting started out with probably a few $100s to maybe a couple $1,000s. And they're trying to find their way in the market. There is no way one service can appeal to that broad range of folks that listen to us. So it's impossible. We don't know everyone's risk profile, and there's no way we could cater to everyone's risk profile. So all we can do is let you know what we think, and you take it from there based on your own personal situation. But this Earnings Beats Digest newsletter, I think, is a really good feature. Obviously, I do. I'm a little biased, but it is a way for us to give back to our community. And this community is very strong, thousands and thousands and thousands, many thousands of folks on this, which we appreciate. When we do our free events, we send out room instructions to anybody that's on this list. So really important to be part of this community if you're not already. Go over to earningsbeats.com, scroll down, make sure you sign up. All right, so for today, what chart of the day? Well, I was looking at a stock, and this is kind of like the poster child of what's going on in the stock market. I like Confluent. I think this is a pretty nice looking constructive chart. You can see it broke out back in May and June, was very strong, topped in mid-July. Does that sound familiar? Because that's when most stocks, when the market basically topped in mid-July. You can see that it had a negative divergence, higher prices, lower PPO. Does that sound familiar? That was one of the reasons why we started talking about being cautious in mid-July, one of the many reasons. But for short-term reasons, not long-term. But anyway, look at that shooting star candle. That's a reversing candle with a negative divergence in play. Went down, posted a low in August. Again, sound familiar? Bounced back up, and we're in a trading range. All of this sounds really familiar. It sounds like the stock market. This is what a lot of stocks are doing. And every time I see this stock move up, I'm thinking, here we go. And then it fails and right back down to the lower end of this trading range. And it's why I keep stressing patience. That, you know, when you're trying to trade a trend that doesn't exist, it's really difficult. I mean, you get whipsawed. You see a stock moving up and you think, okay, here it goes. I'm jumping in. 2 days later, you're back at the bottom of the range again. Or you're moving to the bottom of the range and you're really pessimistic, think the market's going down. You jump in on the short side, and then 2 or 3 days later, we're back toward the upper end of the range. It's working in both directions. This is an equal opportunity market right now. It is, you know, really frustrating both the longs and the shorts. And as a result, we're going nowhere. And I don't know what's going to happen after the Fed meeting tomorrow. Your guess is as good as mine. I do think we'll have volatility. I think whichever direction we move in initially, it will probably not be the direction where we end up going. It'll probably be a head fake, might be a couple head fakes. That's usually typical on the afternoon after the Fed releases its policy statement. So I just wanted to show you, because I think this is a nice chart, breaking out, nice volume on the way up, sideways consolidating now, still holding on to support. But which way do we go from here? And short term, do we break down? Do we have a false breakdown? Actually, that's one thing I would be looking for in charts. If you are more bullish, like I am, and you're seeing stocks that are maybe on the verge of breaking down, if they put in a long tail intraday and come back up, that could be a sign the bottom's in. Or if they break down and then print a reversing candle a day, 2 days, 3 days later after that breakdown, a reversing candle could signal the bottom. Those are some of the things I'd be looking for. But just remember, keep in the back of your mind, this is a much more difficult market than what we saw throughout much of 2023. 2023 there's been a lot of rotation. So we've got certain areas that have done really well. A lot of the technology groups did very well. Many consumer discretionary names, communication services, the aggressive groups. Not so much if you're looking more at financials, industrials, or certainly those defensive groups. Energy and materials have been volatile. Sometimes during the year they've been working, sometimes they haven't. It's not been a buy anything and it goes up kind of market. Sometimes these secular bull market advances are really strong with lots of participation. Other times, not so much. All right, we got about 5 minutes left. I thought what I would do is just show you real quick. These are 2 chart lists that we have at Earnings Beats that, I mean, I think are 2 of the most important. And we make these available to anyone who's an annual member at Earnings Beats. And if you're a Stock Charts member too, you can take these chart lists and download them right into your account. and it's a one-time download. Once you have them, you have them. They don't change. So one is the relative strength sector analysis. And that is where we have just the 11 sectors relative to the S&P 500 on a weekly basis. So we can come in and take a look at the charts and see that technology since the beginning of the year has been doing extremely well versus the S&P 500. 2022, it was leading to the downside during the cyclical bear market. 2023, though, different story. And it still remains pretty strong. That's what, I think that the problem, a lot of bears, those who are in the short camp, I think the thing that they're missing here is as we struggle and even pull back a little bit, money is sticking with the more aggressive areas of the market. This is not setting up for a recession. I mean, it's just not. I mean, yeah, Wall Street's talking about it and it sounds great. Wow, interest rates are up. I mean, sure. Seems like a recession is something that could happen, right? Inverted yield curve. A lot of folks want to throw that out there. That's happened with recessions before. Usually recessions resulting from an inverted yield curve are much later. They're very rarely tied, directly to an inverted yield curve at that particular moment in time. But Wall Street's not repositioning like a recession is right around the corner. And so I think GDP will remain positive. We might see it slow a little bit. I do believe we're going to have a soft landing. I do believe interest rates are going to come back down. But if there's one call, I think I've called the stock market really well, but if there's one call I've struggled with, it's been interest rates, because I have felt all along that we would never have gotten back up. We would never gotten to 4.25%, 4.3, 4.4, whatever. That was not really what I was looking for. I thought maybe we would get up to, 3.25, and then turn right back down. So because I didn't think inflation was an issue, and the market's still telling me it's not an issue, but the Fed keeps talking about it. And I think some of that is still being priced into the 10-year Treasury yield. But anyway, technology is doing well on a relative basis. Consumer discretionary, I mean, since the beginning of the year, still in a nice uptrend. I mean, just recently, the XLY versus the S&P 500 trying to make a breakout, even though the S&P is nowhere near that 4,600. We're still 150 points away. Consumer discretionary on a relative basis trying to make a breakout. Really, consumer discretionary, if there's a recession, this would be one of the hardest hit groups. Instead, one of the strongest on a relative basis. Communication services keeps putting in higher relative highs. Folks, these are your three aggressive groups. These are the three sectors that house most of the major growth stocks. Those three sectors I just pointed out. In a recession, earnings decline. Growth stocks are literally valued based on their earnings. It's not their balance sheet. It's about their earnings growth, their projected earnings and earnings growth. If we had a recession around the corner, these groups shouldn't be performing well, yet they are. Don't listen to CNBC, listen to the charts. Follow the charts. Also, if the market was positioning for a possible recession, where would they be putting their money? They'd be parking it in utilities, real estate, healthcare, consumer staples, not discretionary, consumer staples. Those are the areas that would be showing tremendous relative strength. So let's pull them up. Healthcare, going down. Staples, what the heck, going down. Real estate, multi-year low. Utilities, clearly a downtrend. We have popped a little bit, just a little bit here in the last few weeks, but in a major downtrend. Does this look like Wall Street is positioning for a big downturn? How about the VIX? It is 9:30, so this will be the last chart. Look at the VIX, continuing to move lower. This is when market is going to go lower. Remember, these market makers set option premiums. And that's what's tied to the VIX. These market makers also work for the largest Wall Street firms, most of them. They got a lot of capital. They also have a lot of knowledge, a lot of MBAs working at the Goldman Sachs of the world. The VIX it's the expected volatility. It's what, when I look at the equity only put call ratio, I think about you and me. What are we doing with our money with options? So it's more of gauging the fear level or the complacency at the individual trader level. That's what I use the CPCE for, equity only put call ratio. The VIX is more of a guide, if you will, a map that the market makers are giving us. And if they're not pricing in a lot of volatility into the option prices, chances are we're not going to see a big move ahead to the downside. Folks, 2 days ago, this would have been last Thursday, we had the lowest close on the VIX in 2023. Market makers are not prepping for a big move. Now, if we see downside action next couple of days, you're going to see the VIX spike. But just like all these other spikes, as soon as that selling abates, VIX comes right back down to new lows. The long-term chart on the VIX, if we go out monthly, you see this multi-year uptrend connecting the lows. It's been broken. All the fear that came from the trade war, from the pandemic, from the cyclical bear market of 2022, it's all in the past. We're now trending lower, in my opinion, moving back down toward the probably upper single digits to around 10, 11. That's where I think the VIX is going. And I think that's going to coincide with the market continuing to move up. All right, let's see what the market's doing here as we open. Got a little bit of downside action. We got the Dow Jones down 32, S&P down 10, NASDAQ down 63. Small caps, mid caps up a little bit today, showing a little bit of resiliency. Of course, those areas are closer to support. So as other areas are selling, likely we're seeing some money rotating into these groups, trying to hold on to support. We'll see whether or not that continues. I think the group that's most vulnerable right now, definitely small caps. And I own the IWM. So trust me, I'm watching this. If we get a big breakdown below 179, I would be out of the IWM. If we just keep meandering here in this 179 to 182 range, as we get closer to the end of September, I'm very likely to flip. And actually, I shouldn't say that, because one kind of weird thing is at the beginning of October, small caps historically have not performed well. While the NASDAQ and the S&P 500 do pretty well at the beginning of October, small caps have lagged. So I'm not quite sure what to make of that at this point in time. So I'll be evaluating, but certainly as we get into October, I'm going to be looking more about getting rid of the IWM or getting rid of a portion of it and moving into more leveraged ETFs like the TNA, because I believe small caps, I really believe small caps are going to take off in the fourth quarter. We'll see. Anyway, that's it for me. Hope you enjoyed the show. Thanks to all of you for watching on YouTube. If you like the video, listen, we do things a lot different than just about everybody else. And quite honestly, I think we do it a lot better. That's just my opinion. But I look at things that matter based on my research, and I ignore the things that don't matter, which is basically all the yapping that takes place on CNBC. I've done so much better in the market since I've turned it off. Quite honestly, I do go over to CNBC.com to get futures and to just look at the headlines, just to see the same scary headlines that we always see. But I don't read the articles. I have no interest. Anyway, if you like what we do here at Earnings Beats, please like the video below and subscribe to our channel. We'd love to have you as a subscriber. Turn your notifications on. That way, anytime we go live with any kind of a free show, you'll be notified. Have a great day, everybody, and happy trading.